Welcome to Fitch Ratings Fixed Interest Podcast. I'm your host, Justin Patrie, and today we're talking about the banking sector and U.S. banks in particular. I'm very pleased to have with me Christopher Wolfe, Managing Director and Head of Fitch Ratings North American Banks team. Christopher, let's start from the top as we're almost coming to the end of the year. What have been the big issues and trends for our rated portfolio of U.S. banks this year? Asset quality, capital, profitability, those sorts of things.
Sure, Justin. After what I think was a somewhat turbulent 2023, 2024 has been so far much calmer by comparison. I would say the key issues for U.S. banks have been improving interest rate risk management, gearing up for more stringent capital requirements, and addressing asset quality concerns in certain loan portfolios, namely commercial real estate and, to a lesser extent, some of the consumer loan books. Earnings and profitability have been a mixed bag so far. So while banks have benefited from higher rates, this in turn has caused loan growth to be sluggish and also increased unrealized losses from securities. So for banks with capital markets, it's been a tale of two halves as investment banking started off rather dormant, but has been perking up in the second half as confidence around at least a soft landing has increased. But getting back to the interest rate risk management, banks are positioned in our view more neutrally than they were during the Fed's initial hiking cycle. So we think they'll be better able to manage whatever comes next from the Fed. So we have seen lower rates, and I think lower rates are also helping to banks to nurse some of their unrealized losses, which again should in turn improve capital strength. As for asset quality, as I noted earlier, it's really a CRE story, and within that, it's really it's mainly about office and to a lesser extent multifamily. So those are the key issues that I think we have been focused on through most of this year.
And what about the picture for bank credit ratings? Have there been any notable rating trends at the portfolio level or for certain segments of U.S. banks that are worth mentioning?
So it's a great question, and generally ratings have mostly stabilized during 2024. So if you're just looking at the balance of our rating outlooks on banks, they're mostly stable. So about 80% of our rating outlooks are stable. And there's a balance between positive, which is around 10%, and negative, which is about 10%. So I think that's a good mix. But if we look back, say last year, things were decidedly more negative, and there was far more negative outlooks, which were about 25% of our rated universe, and very few outlooks on positive. So I think there's been a big change there. But even still, most of our outlooks, even last year, were still stable. Not surprisingly, it was the regional banks where we had a more negative view. But following our more recent round of regional banks, which we just completed this month, there was actually one rating upgrade. One outlook was revised to positive, and one outlook was revised back to stable from negative. So again, I would say a more stabilizing theme has emerged, and so we're seeing that play out, and I think that's been a good dynamic so far.
So obviously we have a big event coming up, which is the election, and that's going to be significant for the future policy direction of the government. But are there any specific policy themes that you're thinking about that would be particularly consequential for banks that might emerge post-election?
Clearly, it certainly depends on the outcome, which we don't take a view on it. But if we look at a Harris administration, we see that as mainly a continuation of the Biden administration policy. So, pretty much status quo. So even if there are some differences between, Harris and Biden, most of the focal areas would be the same. So if we look at a Trump 2.0 administration, a couple of things would come to mind, which is one, we think a more deregulatory stance would emerge as it did during his first administration. And what does this mean for banks? Well, first, I think the pace of new rulemaking comes to a crawl. We probably wouldn't see a lot of new rulemakings. And as the Basel Endgame capital rules are not yet across the goal line, there could be implications for how these are ultimately shake out. We think a Trump administration would be more accommodating towards bank M&A. So if elected, we suspect, we'll see more merger and acquisition activity by and amongst the banks. Versus what we're seeing now. I would also note that under the first Trump administration, there was a view of allowing more financial innovation, such as crypto and fintech to take root, and a more, we would probably see a more relaxed tone again for crypto and fintech. Lastly, I would also highlight Fannie Mae and Freddie Mac, which remain under conservatorship, where they were placed, in October 2008 during the global financial crisis. So during the first Trump administration, there were plans actually to release the enterprises from conservatorship, although this was not completed prior to the end of his term. So if reelected, we shouldn't be surprised to see this pursued again.
Can we develop some of the points on bank regulation, and specifically maybe looking back a little bit into 2024? How are you viewing the evolution of the bank regulatory environment in 2024? And is there anything to watch in 2025, regardless of who wins the election?
Yeah, and I'll start with the Basel Endgame capital proposal, which I alluded to earlier, and we'll unpack that a bit more. Because I think those are probably the most impactful item on the regulatory agenda, regardless of the outcome of the elections. So if we go back again in time to last year, so 2023, the bank regulatory agencies, the Fed, the OCC, and the FDIC, released their Basel III Endgame capital proposal. The proposal was met with a significant backlash from a number of quarters, and obviously the banks themselves, but there were others such as housing advocacy groups and Congress as well was rather skeptical of the proposal. And if you look at the comment letters on the proposal, they were decidedly against it, and the agencies ultimately had to extend the comment period. And things were quiet for a little while until about this past September, early September, when Vice Chair for Bank Supervision, Michael Barr, made a speech previewing what were expected reductions to the capital requirements in the proposal, and estimated that these would come down by half from the original. So it was a big change from what was originally proposed. It was also expected that the agencies would re-propose the rule, given the expected changes, and that basically resets the clock and starts a new comment period before the rule can be finalized. But since then, since his speech in September, there have been no developments on the capital rule. So it's unclear why that hasn't progressed any further, but given how close we are to the election, it probably, whatever, will probably come out sometime afterwards. And then that further pushes out the effective implementation date. But the main points I would make about the capital rule are this: first, even with the reduction in the capital proposal, we still see this as improving bank capital adequacy, especially if you close the loophole for the category 3 and 4 banks, where they can exclude the unrealized losses in capital. So basically, capital ratios will go up. Just not as much as the original proposal had wanted. And then 2, based on our analysis and assuming kind of a typical phase-in period for our rated banks, we think they'll be able to comply with the requirement. And so from that perspective, we see this as relatively neutral. So that's probably the most impactful item on the regulatory agenda. But there are a few other things I just want to call out. First, the long-term debt proposal, which would require category 3 and 4 banks, so basically banks over 100 billion, but below the GSIB threshold, to issue some debt that could take losses before depositors. And then there's also been a lot of discussion about liquidity rules, to some degree based on the level of uninsured deposits. So, but we haven't seen those come forth either. But those are things that we'll be watching for.
So we've talked about 2024, we've talked about some trends to look out for in 2025, but I want to end by asking you about something that happened last year, namely the sudden liquidity crunch experienced by certain smaller and specialized banks such as Silicon Valley, which happened in early 2023. Did those events point to something significant for the broader banking industry, or were they just an idiosyncratic flash in early 2023?
Yeah, so it's funny. Liquidity is a funny thing. It's almost always there when you don't need it, but hard to get when you do. We characterize the events of March 2023 as more of what we call a crisis. So it's a stress for most, but crisis for a few. And so yes, and in our minds there was some idiosyncratic element to this. And when you think about the banks that were most caught out or affected, like SVB, or First Republic, they were in fact material outliers in terms of their deposit structure and with very high concentrated reliance on uninsured deposits, and as well as having large unrealized losses in their securities portfolios. So banking is always a confidence game, and what looked at first like a liquidity event turns out to have been more of a view on solvency for some of these banks. So, notwithstanding, we saw in March, it revealed some problems with bank liquidity management, in particular, access to contingent funding. So, I think there are a couple of important lessons for the industry as a whole that learned, which is one, banks need to make sure they have adequate access to that funding. So one of the problems banks ran into was operational constraints in terms of accessing, the Federal Home Loan banks and/or discount window. And so you have collateral at both, but you can't easily move the collateral between the two. And so we are seeing banks, test their access more regularly and position more collateral at the Federal Reserve in the event of liquidity stress. And I also think the March experience revealed the importance of understanding, the composition of deposits, particularly insured versus uninsured, and operational versus non-operational. So the insured deposits and the operational deposits proved to be a lot stickier than the uninsured and the non-operational deposits. So basically, I think, that's an important lesson that I think a lot of banks learned, and making sure you're not over reliant on kind of the more uninsured and/or non-operational deposits.
Well, thank you very much, Christopher, for sharing your thoughts on U.S. banks. To our audience, I hope you've enjoyed this latest edition of the Fixed Interests podcast. As always, we thank you for listening and subscribing. And if you are listening and want to learn more about Fitch's credit ratings and views, please visit our website at fitchratings.com.